Think about the last time you went shopping. Maybe you bought a bottle of Italian wine that seemed surprisingly affordable, or a smartphone from South Korea whose price tag had recently shot up. Most of us just see the price tag. We don't see the invisible forces quietly shaping those prices, the exchange rates. That wine isn't produced in US dollars. It's priced into the relationship between the dollar and the euro. The smartphone's price, it's telling a story about the relationship between the dollar and the Korean won. These exchange rates, numbers that change every second of every day, affect what you can afford, what businesses decide to import, and which countries' products are competitive in the global market. Every global price tag is a puzzle, and today we're going to start learning how to solve that puzzle by learning the language of exchange rates, how they work, why they matter, and how they shape international trade.
So, what exactly is an exchange rate? At its simplest, an exchange rate is just the price of one currency in terms of another. If you've ever traveled internationally or exchanged money at an airport, you've seen exchange rates in action. You might walk up to a counter and see that one US dollar gets you about 150 Japanese yen or 0.91 euros. That number tells you how much of one currency you need in order to buy a unit of another. Just like any price, exchange rates are shaped by supply and demand, only instead of trading goods, we're trading currencies. Today, countries generally operate under one of three broad exchange rate systems. At one end are floating exchange rates, sometimes called flexible exchange rates. Here, market forces, supply and demand, determine currency values with little or no government intervention. Most major reserve currencies fall into this category, including the US dollar, the Swiss franc, Japanese yen, the euro, the British pound. Central banks may occasionally intervene to stabilize markets, but the overall system remains market driven. The Canadian dollar is perhaps the closest to a true floating currency. The Canadian Central Bank hasn't intervened in more than 2 decades. At the other extreme are fixed exchange rate systems, or pegged systems. Here, governments attempt to maintain the value of their currency relative to another currency or commodity like gold. They attempt to eliminate exchange rate fluctuations entirely. Fixed systems are rare today, but were historically common. Most countries backed their currencies with gold before World War II. The US maintained a fixed exchange rate system until 1973. China followed a fixed system until 2005, when, in a major shift for the global economy, it moved to a managed float. And that brings us to the middle ground, the managed float systems, sometimes called dirty floats. In these systems, governments allow some market fluctuation but intervene as needed to keep the exchange rates near a preferred target. Today, roughly half the world's countries used managed floats, including India, Argentina, Kenya, and Thailand. These systems offer some of the flexibility of floating exchange rates and some of the predictability of fixed ones, but they can also be difficult to manage and at times have triggered major financial crises, especially in emerging markets. Currencies are also sometimes classified as being hard or soft. Hard currencies, like the US dollar, the euro, the pound, and the yen, are widely accepted, hold their value well, and are used for most international transactions. Soft currencies, by contrast, tend to fluctuate more and are less trusted globally. Countries hold foreign exchange reserves, usually in hard currencies, to pay for international transactions, to service debt, and to hedge against future uncertainty. These reserves also reflect global power dynamics. This chart shows the breakdown of official forex reserves held by governments. The US dollar still dominates, accounting for just under 60% of global reserves, a share that's gradually declined but remains highly significant. The euro comes in second at around 20%. The British pound and Japanese yen account for about 4 to 5% each. The Canadian dollar and Chinese renminbi are growing but still represent about 2% each, and all other currencies, including Swiss francs, Australian dollars, and so on, collectively make up the rest. So, what's the advantage of having your currency as the global reserve? For the United States, it creates a steady demand for US dollars. This makes it easier to run trade deficits and to borrow cheaply, since other countries are willing to hold U.S. Treasury bonds. And unlike most countries, the U.S. issues debt in its own currency, meaning it's not vulnerable to exchange rate shifts. This dynamic led France to criticize the post-war monetary system as America's exorbitant privilege. As economist Barry Eichengreen put it, it costs only a few cents for the Bureau of Engraving and Printing to produce a $100 bill, but other countries have to pony up $100 of actual goods to obtain one. Of course, the US can't print money indefinitely without risking inflation, but the ability to operate the global economy in your own currency brings significant power. It also enhances US influence. For example, because so much of global trade is dollar-based, the US can use financial sanctions more effectively than almost any other country. But this status also comes with costs. One of the most famous is the Triffin dilemma, which highlights a conflict. The US must supply the world with dollars to meet reserve demand, typically by running deficits. But those same deficits can undermine long-term confidence in the dollar. At the same time, constant global demand tends to overvalue the dollar, making U.S. exports less competitive and contributing to further trade imbalances. Over time, these dynamics can affect domestic production, employment, and global economic stability. So exchange rates aren't static, they fluctuate constantly, and countries often try to influence them. When a currency appreciates, its value rises relative to other currencies. For example, if the US dollar appreciates against the euro, you can buy more euros with the same amount of dollars. When a currency depreciates, the opposite is true. $1 will buy fewer euros. In floating exchange rate systems, these changes happen through supply and demand, but governments may also try to intervene. A revaluation is a government-induced increase in the currency value, while a devaluation is a deliberate weakening of the currency. In fixed exchange rate systems, governments can simply declare a new rate, but this only works if markets accept it. If not, a parallel market may emerge. In Zimbabwe in the early 2000s, for example, the official exchange rate was about 2,000 Zim dollars to $1 US, but the street rate was over 20,000 to 1. In floating systems, governments have fewer direct tools. Central banks may adjust interest rates, raising them to attract foreign capital and strengthen the currency, or lowering them to weaken it. Governments may also buy or sell their own currency in global markets to affect its value. Inflation rates, especially when they exceed inflation rates abroad, can also tend to erode a currency's value. Today, global currency markets are massive. Over $7.5 trillion are traded daily, according to the Bank for International Settlements. That's more than the entire world's annual GDP traded in just a few weeks. Because of this enormous volume, central banks often find themselves reacting to markets, not leading them. So, why does this matter? Because a weaker currency makes exports cheaper and imports more expensive, while a stronger currency makes imports cheaper but can hurt exports. Depreciation can help exporters but may scare off investors or increase debt costs. And when multiple countries devalue at once, it can trigger a currency war, a race to the bottom that helped spark the Great Depression. Not all currency interventions are market-based. Sometimes countries are accused of manipulating their currency to gain unfair trade advantages. Currency manipulation occurs when a government intentionally weakens its own currency, usually by accumulating foreign reserves, often with the goal of making exports cheaper. The most famous example is China, which for much of the 2000s was accused by the United States of keeping the yuan artificially low in order to boost its exports. In 2019, the U.S. Treasury even labeled China a currency manipulator, escalating trade tensions. Other countries like Japan, South Korea, Switzerland, and even Germany have faced similar accusations at times. Currency manipulation can act as a hidden form of protectionism. Instead of raising tariffs, countries can lower their exchange rates to make imports more expensive and exports more competitive without technically violating trade rules. That's why exchange rate policy isn't just economics, it's a key tool in global politics.
So the next time you see a price tag on a bottle of wine or a smartphone, remember, there's more to that number than just supply and demand. Exchange rates shape what things cost, where they come from, and who wins and sometimes who loses in the global markets. Currency values reflect the push and pull of markets, central banks, and government policies, and sometimes even strategic manipulation. We've seen how appreciation and depreciation affect trade, how reserve currencies like the US dollar control or confer global power, and how accusations of manipulation can turn technical debates into geopolitical conflicts. In our next video, we'll look at how all of this gets recorded and measured through balance of payments and balance of trade. These tools help us understand not just individual prices, but the broader flow of goods, services, and capital between countries. Thanks for watching, and remember, every global price tag tells a story. Learning the language of exchange rates is how we read it. So, the next time you see a price tag on a bottle of wine or a smartphone, remember there's more to that number than just supply and demand. Exchange rates shape what things cost, where they come from, and who wins and sometimes who loses in the global markets. Currency values reflect the push and pull of markets, central banks, and government policies, and sometimes even strategic manipulation. We've seen how appreciation and depreciation affect trade, how reserve currencies like the US dollar control or confer global power, and how accusations of manipulation can turn technical debates into geopolitical conflicts. In our next video, we'll look at how all of this gets recorded and measured through balance of payments and balance of trade. These tools help us understand not just individual prices, but the broader flow of goods, services, and capital between countries. Thanks for watching, and remember, every global price tag tells a story. Learning the language of exchange rates is how we read it.